Hey everyone, welcome back. If you have been seeing national housing headlines lately, you are probably seeing words like recovery or normalization. And if you live anywhere in Silicon Valley, you already know that the national news feels like it's coming from a different planet. While the rest of the US is debating whether a crash is coming or boom is happening, the Bay Area is doing its own thing. I call it the Silicon Valley Anomaly. We have a AI wave minting new millionaires every week. We have a housing supply that is essentially frozen in ice. And we have a market that defies every national cycle every single time. Before we get into the data, a quick word on why I look at the market a little differently. I am a computer science engineer. I am PMP certified. I used to work in Bharti Airtel as a tech lead. This is not a usual realtor background. When I transitioned into real estate here, I realized something immediately. A home is not just a building. For most families, it is their largest financial asset. Whether you are an engineer at NVIDIA looking to vest and buy, or you're a founder planning an exit, or a family relocating from out of state, you deserve a strategy that is disciplined as a product roadmap. Not hype, not fear, data. I'm stripping away the noise. We are going to look at how Bay Area stacks up against the rest of the US, what the last 2 years of data actually show, what Zillow, Redfin, NAR, and C.A.R, California Association of Realtors, are projecting for 2026, the specific micro markets that are moving faster versus the rest are sitting still, and most importantly, what all of this means for your next move. Let's jump into the number. The single most important thing I want you to take away from this entire video, and I want you to write it down as if you are taking notes. The Bay Area is not one market. It is a jigsaw puzzle of 9 counties and dozens of tiny micro markets, all behaving differently simultaneously. Think about it. The condo market in Soma in San Francisco is behaving completely different than a single family home in top tier San Jose district. Even within one city, moving 2 blocks can change your price point by $200K because of a school boundary line. So, when a friend says, I heard Bay Area prices are falling, ask them which county, which city, what is the property type? Because the answer is completely different depending what you're looking at. Right now, in 2026, we are seeing what we call a K-shaped divergence. On the top of K, luxury and tech adjacent homes. These are far less sensitive to interest rates because buyers are not rate constrained. They are equity flushed. They have RSUs, restricted stock units, that tripled in value when NVIDIA and other AI stocks surged. They are putting 40% or 50% down. A 6% mortgage rate is almost irrelevant to their decision. On the bottom of the K, that is the entry-level market. Buyers feel every single basis point move in mortgage rates, where the affordability is tight and every rate announcement matters. If you are not looking at data for your specific zip code and your specific property type, you are probably flying blind. And that is what this video is here to fix. Now, let me give you the national context first, so you understand just how much of an outlier we are. Nationally, the housing market is in what Redfin calls the Great Housing Reset. Not a crash, not a boom, a long, slow normalization after the wildly distorted pandemic years. Here are the national numbers. US median home sale price around $410,000 to $420,000. Nationally, home values were roughly flat in 2025. Redfin projects 1% price growth in 2026. NAR's chief economist Lawrence Yun forecasts 2% nationally. And critically, there are 37% more home sellers than home buyers nationally right now. That is the largest seller surplus since records began in 2013. Markets like Austin, Texas have 114% more sellers than buyers. San Antonio 106% and Nashville 104%. These markets are cooling hard. And here's what Bay Area numbers look like alongside those numbers. Bay Area median home price as of December 2025 is $1.2 million, nearly 3 times the national median. Bay Area unsold inventory index is 1.6 months. The national average is 2.7 months. In Santa Clara County specifically, San Jose, Cupertino, Mountain View, Sunnyvale, inventory is just 1 month and homes are selling in 14 days or under. That is not a cooling market. That is a market under structural pressure. And the reason comes down to what I call 3 system variables that the national model simply cannot account for. System variable 1, the AI equity injection. We are not a salary-based economy. We are an equity-based economy. While a buyer in Austin or Phoenix is capped by their gross monthly income, a buyer at NVIDIA or OpenAI is looking at their RSU refresh that just tripled in value. While the stock market hits all-time highs, our local down payment pool expands instantly. Cash-heavy buyers who aren't even thinking about the 6% rate because they are putting 40 to 50% down. This creates demand that national housing models do not model because it doesn't exist anywhere else in the country at the scale. System variable number 2, the 85 inventory lock. This is the classic supply chain bottleneck. Roughly 80% of California homeowners are sitting at a mortgage rate 5 or below. They have zero incentive to sell, move, and trade that 3% rate for a 6.5% rate. Unlike 2008, where people were forced to sell, today's homeowners can just sit. They are not moving. This artificially suppresses the total addressable market for listings, which keeps prices firm even though the demand has slowed slightly. This is the single biggest reason Bay Area has not corrected in a way the national headlines have been predicting. Now let's talk about system variable number 3, the return to office compression. While remote work is still a reality, major AI hubs are pulling talent back to the Peninsula and South Bay. We are not seeing a broad regional boom. We are seeing a hyper-local density compression around specific zip codes near major tech campuses. Concentrated demand in a constrained supply environment equals to one thing: pricing support. These 3 variables together creates a floor on Bay Area prices that simply doesn't exist anywhere else in the country. This is the Silicon Valley anomaly that I referred to earlier in the video. To understand where we are, you have to understand where we have been. Let's go back to 2023. 2023 was rough. The Federal Reserve raised rates aggressively. The 30-year mortgage rate peaked above 7.5% in late 2023. Tech layoffs swept Silicon Valley. Buyer confidence dropped. Santa Clara County saw corrections of 10 to 15% from the 2022 peak in some segments. The condo market was hit the hardest. Investors trying to exit flooded that segment with supply exactly when demand dried up. But here is what I always tell my clients. The buyers who acted in early 2023 when the sentiment was at its absolute worst, they are sitting on some of the best purchases of the decade so far. Pessimism was the buying signal. It always is. And 2024 was the recovery year. Bay Area home sales rose 16.2% year over year as of October 2024. Santa Clara County saw a 15.6% rise in sales volume. Alameda County jumped 23.1%. Prices recovered. Bay Area median was 1.3 million in July of 2024, up 3.6% year over year. Contra Costa prices rose 4.5% and Marin County 7.9%. What drove it? The AI equity injection I just described. When NVIDIA tripled, when OpenAI hired aggressively, when Anthropic, XAI, and dozens of AI startups raised massive funding rounds, those workers needed somewhere to live. And they chose the South Bay and the Peninsula. The AI hiring wave turned into a housing demand wave with about an 18-month lag. Now, 2025, that's the divergence year. 2025 is when the K-shape I described earlier became impossible to ignore. The Bay Area split into 2 genuinely different stories. On the top of the K, Santa Clara and San Mateo counties held firm and in some cases surged. Santa Clara County posted over 12 consecutive months without a single year-over-year price decline for single-family homes. San Mateo County? San Mateo County median prices jumped 11.6% year over year to $2,058,000 by December of 2025. San Francisco single-family median price were 10.9% year over year to around $1.7 million. In April 2025, SF single-family homes were selling for 114% above asking price, a level not seen since before the Fed began raising rates. On the bottom, East Bay struggled. Alameda County single-family prices were down 2 to 4% year over year across multiple months. Contra Costa County fell harder, down 6.56% year over year by August 2025. Napa County dropped around 15% in single-family prices in one stretch. And the condo market was the worst hit segment across the entire region. Condo market and single-family market are operating on completely different rules right now. Now, let me walk you through what major forecasters are saying, starting with Zillow. Zillow's national forecast says home values up by 1.2% in 2026, with 4.26 million existing home sales, a 4.3% increase from 2025. Mortgage rates staying above 6% throughout the year. For the broader San Francisco Bay Area metro, Zillow projects a gradual, modest softening through much of 2026. Approximately a negative 1.6% by November 2026 for the region overall. But for San Jose specifically, their numbers shows a slight uptick, consistent with Silicon Valley's tech employment story, providing a floor that the rest of the Bay Area doesn't have. Zillow's bottom line, it's not a crash. A period of stabilization for Bay Area overall, with Silicon Valley and Peninsula outperforming. Now, Redfin is calling 2026 the Great Housing Reset. And I think that framing is useful. Their specific numbers, 30-year mortgage rates averaging 6.3% in 2026, down slightly from 2025. US median home price rising just 1% year over year. And here's the line I find most significant. Wages are projected to grow faster than home prices for a sustained period of time for the first time since 2008. This is actually good news for the buyers. Affordability improves not through prices crashing, but through incomes gradually increasing. For the Bay Area specifically, Redfin calls out Palo Alto, Cupertino, and Fremont as expected to outperform. NAR's chief economist Lawrence Yun is the most optimistic of the three. He's forecasting existing home sale rising 6% in 2025 and 11% in 2026, driven by what he calls the magic bullet of easing mortgage rates. He expects them to average 6.1% year by year end. For California C.A.R., that means California Association of Realtors, they are projecting their 2026 median at record $905,000 for a single-family homes statewide, up 3.6% from 2025 levels. Their economist is describing it as improving affordability, setting the stage for more optimistic 2026. My honest synthesis, none of the major forecasters are predicting a crash. They're all converging on a stabilization nationally, modest growth in California, and continued growth in Silicon Valley and Peninsula. The three system variables I described, AI equity, inventory lock, and RTO compression, do not appear in any of their models, which means Silicon Valley projections are still underestimating the South Bay's resilience. Before I move on, 1 minute on mortgage rates because they are single biggest lever in this market right now. Rates peaked at 7.5% in late 2023. They have been gradually coming down, hovering in 6 to 6.5% range through most of 2025. Every forecaster agrees that they won't go below 6 for a meaningful period of 2026. But here's what I call the engineer's insight on the rates. And this is something I watched firsthand in this market. 5.99% is the magic number. It is a psychological threshold. In early 2026, the moment rates dropped below 6%, pending sales in San Jose jumped 17% in a single month. Not because the math changed dramatically, because people saw a 5 in front of the rate and they moved. If you're waiting for the news to announce rates at 5.9% before you start looking, you will be standing in a line of 20 other buyers for your San Jose home. My advice, marry the house and date the rate. You can refinance the debt. You cannot refinance the purchase price once you have overpaid in the bidding wars. Now, this is the most practical section of the video. Let me break down Bay Area market by market and tell you exactly where the homes are flying off the shelf and where they are sitting. Okay, the fastest markets first. Places where if you see a home you want, you have days, not weeks. Number 1, Santa Clara County. The Silicon Valley core, Cupertino, Sunnyvale, Mountain View, Palo Alto. In April and May of 2025, average single-family homes here were selling in just 8 days. By December of 2025, it crept up to 14 days. Still an extraordinarily fast market. Inventory is 1 month of supply. This is a hard seller's market and has been the same for years. Cupertino, home of Apple, has a median approaching $3 million and rose around 2% year over year despite higher rates. Analysts project 2 to 5% appreciation in 2026. Palo Alto's median is in mid 3 millions and is likely to stay near the record highs. Sunnyvale and Mountain View are highest volume cities in this county, with strong tech employer agency driving consistent turnover. Next to the San Mateo County, the Peninsula, Menlo Park, Redwood City, San Mateo, Millbrae. Homes are selling in 10 to 15 days. Inventory is at 1 to 1.7 months supply. Median prices are up by 11.6%. Year over year, $2,058,000 in December of 2025. Sales volume jumped 25% year over year in December of 2025. The Peninsula is carrying some of the strongest numbers in the entire Bay Area right now. Now, there's an important distinction within the San Mateo County. The affluent corridor of Menlo Park, Atherton, Woodside is a completely different animal from Daly City or South San Francisco. The gains are concentrated near the big tech employers. Always look at the specific city, not the whole county as one animal. Now, let's talk about number 3, San Francisco. San Francisco, single-family homes sold at 114.7% of the list price in April of 2025. Single-family homes inventory was down by almost 16% year over year, but the SF condo market is a completely different story, which I'll get to in a moment. In the middle tier, there is more breathing room for the buyers. We have South Bay entry-level corridors and East Bay. Milpitas, Berryessa corridor in North San Jose are in a sweet spot. Milpitas appreciated 10.5% year over year, the fastest appreciating city in Santa Clara County that I track. The combination of Cisco and KLA being headquartered in the city, active new construction, and BART proximity creates a unique, compelling profile. Alameda County. Now let's talk about Alameda County, Oakland, Berkeley, Fremont, Union City. Single-family homes selling in about 12 to 19 days. Prices have been under pressure, down 2 to 4% year over year in multiple 2025 readings. But the East Bay remains the most affordable entry point into the Bay Area. And Redfin specifically called out Fremont as a city likely to outperform national trends. For buyers who need more house per dollar, the East Bay, especially the Tri-Valley area, is still worth serious consideration. In Contra Costa County, like Walnut Creek, Concord, Antioch, Brentwood, is where Bay Area meet the Central Valley. Prices have dropped meaningfully in this pocket. Here's my bottom line for 2026. And I want to be straight with you. 2026 is not going to be a boom or a crash. It is a strategy year. The national headlines are going to tell you one story. Your specific zip code is going to tell you another. The buyers who do well this year are not the ones who waited for perfect conditions. Perfect conditions do not exist in this market. The buyers who do well are the ones who have defined their strategy, picked their micro market, and executed with discipline. Buyers, inventory is up 10% from last year, which is the most breathing room you have heard in South Bay in several years. You can actually ask for an inspection again, and that is a win. You can be selective, but don't confuse the breathing room as the buyer's market in Silicon Valley. It isn't one. Quality homes in right school zones are still moving under 2 weeks and often way over asking. The window you have is to find the right asset, not just any asset. If you're waiting for rates to crash to 4% before buying, the data says you may have to wait until 2028 or even later. And homes you're looking at today will be more expensive by then. The 5.99% threshold is the one to watch. When it breaks, the line forms immediately. If you're waiting for a Bay Area crash, the 3 system variables are laid out make a broad Bay Area crash structurally unlikely in the near term. The inventory lock, the equity economy, and the return to office compression are not going to go away any soon. What's more likely is continued K-shape. Segments softening and others appreciating. Choose your segment wisely. Sellers in Santa Clara and San Mateo counties, you are still in seller's market. Price with data, present well, and you will move quickly. Sellers in East Bay, North Bay, and especially condo sellers, the powers have shifted. The number one mistake I see right now is overpricing. Homes that sit 30 plus days get labeled as damaged goods by some buyers, even when nothing is wrong. Price it right from day one. If you want to see specific data for your zip code, or you want to sit down and map out a project plan for your next move, that is exactly what I do. Click the link in the description to get in touch. I love to help you engineer your next step. That is the Bay Area real estate market, as honest and complete as I can make it. The Silicon Valley anomaly is real. It has been real for 50 years. And the AI wave is the latest chapter in this story. Proximity to where the world's most important technology gets built has always been worth something. Right now, it is worth more than ever. The Bay Area is not one market, navigated like a jigsaw puzzle. It is county by county, zip code by zip code, property type by property type. I'm Sanna. If this video gave you some clarity, share it with someone who is considering buying to make sense of the market. Please hit like and subscribe if you want to see my content again, and I'll catch you in the next one.